What happens if the dollar falls? What would actually occur if the value of the US dollar began to decline? Since the dollar is the global reserve currency, many people outside of the United States are impacted by its strength or weakness. It has an impact on international investment, trade, and even geopolitical power. After explaining what occurs when the dollar falls, we'll look at 3 investor playbooks that can help you manage and even make money off of currency risk. Number 3, imports get pricier, exports get cheaper. When the dollar loses value, the most immediate effect is seen in imports. The US is heavily dependent on foreign goods, from crude oil and cars to electronics and everyday consumer items. Because most of these goods are priced in dollars on the international market, a weaker dollar means American buyers must pay more dollars to import the same product. For households, this translates into higher prices at the gas station, higher grocery bills, and more expensive electronics or clothing. This process directly fuels inflation, making the cost of living rise. However, the flip side is positive for American exporters. Companies that sell goods overseas, such as farmers, industrial manufacturers, and aerospace firms, suddenly become more competitive because their products are cheaper for foreign buyers. That can drive higher sales abroad, supporting jobs and revenues for industries that rely on global trade. Number 2, foreign investors demand more dollars. A declining dollar doesn't just affect shoppers, it changes how foreign investors behave. Imagine a European investor holding euros. If the dollar falls, their euros suddenly buy more US assets. That makes American stocks, real estate, or even government bonds look like discounted bargains, which often attracts waves of foreign money into the US economy. This inflow of capital can temporarily support asset prices, offsetting some of the domestic pain of a weaker currency. But the story isn't always positive. If investors see the dollar's fall as a symptom of deeper problems, such as high debt, political gridlock, or economic instability, they may hesitate to put their money into the US. In fact, they may pull funds out and move them into perceived safe havens like gold, the Swiss franc, or even the Japanese yen. The reaction depends on confidence. Is the dollar just adjusting? Or is it signaling something broken in the US financial system? That perception drives whether foreign money flows in or rushes out. Number 1, inflation and global confidence ripple effect. The biggest long-term consequence of a falling dollar goes beyond day-to-day price changes. It's about confidence. The US dollar is the world's dominant reserve currency. Central banks across the globe hold trillions of dollars in reserves, and most international trade contracts, especially for oil and commodities, are priced in dollars. If the dollar weakens significantly, central banks and foreign governments may start diversifying their reserves, shifting into euros, yuan, or gold. This isn't just a financial move, it's a political one, because it reduces reliance on the US. Over time, that shift could weaken America's ability to influence global trade and finance. Domestically, it also means higher long-term inflation risk, as the US would have less power to borrow cheaply from the world. In short, while a mild dollar decline can boost exports, a sharp or sustained fall could trigger a slow but powerful rebalancing of global economic power. 3 investor playbooks for currency risk. Playbook 3, hedge with assets tied to hard value. One of the most time-tested ways to guard against a weak dollar is investing in hard assets like gold, silver, and commodities. Because these assets are priced globally in dollars, their prices usually rise when the dollar weakens. For example, if the dollar falls, it takes more dollars to buy the same ounce of gold, so gold prices appear to climb. The same applies to oil, natural gas, and other commodities. These assets are seen as inflation hedges because they maintain purchasing power when paper money loses value. Some investors also use Bitcoin or other cryptocurrencies as a modern form of hedge, treating them as digital gold. While crypto can be highly volatile and risky, the underlying idea is the same. When fiat currency weakens, alternative stores of value become more attractive. For a balanced portfolio, adding a slice of hard assets can act as insurance against dollar decline. Playbook 2, own companies that benefit from a weak dollar. Another smart playbook is to look at which businesses actually benefit when the dollar weakens. Export-heavy industries are the biggest winners. Companies like Boeing, which sells aircraft globally, or American farmers who ship crops overseas suddenly see their goods become cheaper and more competitive for foreign buyers. As demand rises, so do revenues and profits. Multinational corporations are also positioned to gain. Take Apple, for example. It earns a large share of its sales in Europe and Asia. When those euros or yen are converted back into dollars, a weaker dollar means the company records higher revenue in its financial statements. This currency effect can significantly boost earnings during periods of dollar weakness. For investors, that means targeting companies with strong international exposure is a practical way to profit from what otherwise might seem like a negative trend. Playbook 1. Diversify globally. Perhaps the most straightforward and effective strategy is global diversification. Relying solely on the US dollar ties your financial future to one currency. By investing in international stocks, foreign bonds, or even overseas real estate, you spread your risk across different currencies and economies. If the dollar falls, the value of these foreign-denominated assets rises when measured back in dollars, providing a built-in hedge. At the same time, global diversification isn't just about protection, it's also about opportunity. Many international markets, particularly in Asia and emerging economies, may grow faster than the US, offering higher returns over time. With the wide availability of international index funds and exchange-traded funds, diversifying across currencies and countries has never been easier. For long-term investors, it's both a shield against currency risk and a way to tap into global growth. So what really happens if the dollar falls? Imports become more expensive, exporters gain a competitive edge, and foreign investment flows shift depending on global confidence. At the same time, the ripple effects on inflation and the dollar's role as the world's reserve currency could reshape the financial system over time. But as an investor, you don't have to just watch and worry. By hedging with hard assets, owning companies that benefit from a weak dollar, and diversifying globally, you can position yourself to protect wealth and even uncover new opportunities. If this breakdown helped you understand the bigger picture, make sure to like, subscribe, and share, because the smartest money moves always start with knowledge.